Okay, let's dive into this week's study session for ACC 202, where we're tackling the notoriously tricky beast of revenue recognition. Look, if you've been staring at the textbook and scratching your head, trust me, you are absolutely not alone. Revenue is literally the lifeblood of any business, and figuring out exactly how to measure it is, without a doubt, one of the most critical topics you're going to face this entire semester. I know week 8 can feel a bit overwhelming, right? Midterms might be in the rearview mirror, but finals are looming, and suddenly you're hit with a massive standard like AASB 15. But hey, take a deep breath. This explainer is designed specifically for you. Think of it as your foolproof, exam-ready blueprint to mastering AASB 15. We're going to cut right through the academic jargon and focus strictly on what you actually need to know to ace your assessments. Here's our roadmap for this explainer. 1. Scope and definitions. 2. The 5-step model. 3. Pricing and allocation. 4. Goods versus services. And 5. Real-world revenue.
Kicking things off with Part 1, Scope and Definitions.
Grab a pen and highlight this in your notes because examiners absolutely love to test your knowledge of boundaries. AASB 15 applies to all contracts with customers, except for a few highly specific areas that have their own rules. Don't get trapped on multiple-choice questions. If a scenario throws a lease agreement at you, an insurance contract, or a financial instrument, red lights should be flashing in your head. Remember, they fall completely outside this standard scope. They belong to AASB 16, 17, and 9 respectively.
Now, it's super crucial to separate the broad umbrella of income from revenue. In accounting, words really matter. Income is the broad definition from the conceptual framework. It's basically any increase in assets or decrease in liabilities other than equity contributions. But revenue, that's much narrower. It only arises in the course of a business's ordinary, day-to-day activities. Remember, all revenue is income, but some income comes from outside ordinary activities, like, say, selling off an old factory machine. Those are classified as gains. Plus, revenue is typically reported gross, while gains are presented net. Keep that distinction crystal clear for your short answer questions.
Moving right into Part 2, the 5-step model.
This sequence right here, this is your universal cheat code for solving literally any revenue problem they throw at you. You have to memorize these 5 steps in this exact order. Identify the contract, identify the performance obligations, determine the transaction price, allocate that price, and finally recognize the revenue. If you try to skip straight to step 5 on an exam question without showing your work for steps 1 through 4, you are leaving major marks on the table. Let's talk about where students usually trip up on the first 2 steps. For step 1, a contract only exists if there are enforceable rights. So a contract doesn't actually exist under this standard if both parties can just walk away unilaterally without compensating the other party. It's basically a phantom contract. For step 2, identifying obligations, the magic word you need is distinct. A good or service is only distinct if 2 criteria are met. The customer can benefit from it on its own, and your promise to transfer it is separately identifiable in the contract. For example, if a client just buys a pile of bricks and cement that you're contracted to build into a single wall, the individual bricks aren't distinct obligations. The finished wall is.
All right, Part 3, Pricing and Allocation.
Step 3 isn't always just looking at a simple sticker price. You've got to do some heavy lifting. If there are bonuses, discounts, or penalties, you've got variable consideration. You have to estimate this using either a probability-weighted expected value or the most likely amount. Now, if the customer is paying you a year later, you have deferred consideration, which means there's a significant financing component, so you absolutely must adjust for the time value of money. And if a customer pays you by swapping goods instead of cash, you measure that non-cash consideration at fair value. When you hit step 4 and need to allocate that total transaction price for a bundle, say a brand new mobile phone and a 12-month data plan, you don't just guess how much revenue goes to the phone and how much to the plan. You allocate the total contract price based on their relative standalone selling prices. You always weigh the allocation based on what you would charge if you sold each of those items completely on its own.
Down the home stretch with Part 4, Goods versus Services. Before we split goods and services, you need to commit this definition to memory. Control is the ability to direct the use of and obtain substantially all of the remaining benefits from the asset. Transferring control is the absolute linchpin for recognizing revenue. It's no longer just about transferring risks and rewards like the old accounting standards used to say. It is all about control. If the customer doesn't control the asset, you cannot book the revenue, period.
Picture this in your head for the exam because you need to visually separate these two concepts. Selling a physical good, like a laptop, usually transfers control in a single instant at a point in time. You hand it over, they own it, boom, revenue recognized. But a service like a year-long consulting contract or a cleaning service transfers benefits continuously. That obligation is satisfied over time. To measure that revenue as the year progresses, you have to use approved methods. You can use output methods, like surveying the actual performance completed, or input methods, like tracking the labor hours you've expended so far.
If you're taking notes, you're going to want to snap a picture of these delivery rules right now because these special situations are guaranteed to show up as tricky scenario questions. If a buyer asks you to hold on to their goods, a bill and hold, you can only recognize revenue if very strict criteria are met, proving they actually have control even without physical possession. If you ship goods with major conditions attached, like a massive installation requirement, you must defer revenue until that's totally done. And for consignment sales, if you give a dealer your products to sell, you don't recognize revenue when you drop them off at their shop. You only recognize it when the dealer finally sells it to the end customer.
Let's bring it all together in Part 5, Real-World Revenue.
Let's test this out with a real-world scenario. Imagine you drop $1,000 on a flight, and you get 5,000 frequent flyer points as a perk. Let's apply our 5 steps. When an airline sells you that ticket, do they get to recognize all that cash as revenue for the flight on day 1?
Well, under AASB 15, the actual flight and those loyalty points are distinct. That's step 2. Because they're distinct, the airline has to split that $1,000 transaction price based on their standalone selling prices, and that's step 4. They recognize the flight revenue when your plane lands, but they must defer the portion of the revenue allocated to the points as a liability. They only get to recognize that points revenue months or even years later when you actually cash them in for that free holiday.
As you're cramming for your exam this week, I want you to step back and ask yourself this. If the rules of revenue timing are this strict, if recognizing $1 million today versus next year literally comes down to whether a minor or major condition was met, what does that tell us about the immense power of an accountant? You aren't just recording history, you are shaping how the entire world, from investors to employees, perceives a company's success. Master these 5 steps, really understand the nuances of control, and you won't just pass ACC 202, you'll truly understand the language of business. Happy studying and good luck!